So we are told this is August 20. For those who have just come in, we are going to do August 2018, question number 6, and this one handles dissolution of a partnership. So in this question, we are told that Wanda, Kalule, Mwambu are partners trading as Wafanya Kazi, traders exporting cereals to Southern Sudan. Their profit or loss sharing ratio is 4:1:3 respectively. Due to the insecurity in Southern Sudan, the partners have decided to dissolve the partnership. The following is their statement of financial position as of 31st of December 2017. So they gave us the non-current assets. The current assets are also given. The capital accounts, the current accounts are also given. The current liabilities are also given. And we have some additional information here. They are giving us the amounts realized from the sale of assets, land, plant and equipment, inventory. Note number 2, Wanda took over the motor vehicle at 14 million as part of settlement of his loan. When you read through, you see that in the current liabilities, Wanda gave the partnership a loan of 15 million. We are also told that the dissolution expenses are 3.5 million. The accounts receivables were factored at 23.5 million, while Wanda took over 10 million of the accounts payable and the balance was paid off less 10%. Kalule could only manage to meet half of his deficiency before he became insolvent. So in that sitting, we are required to prepare for Wafanya Traders Limited as of 31st of December, the realization account, the bank account, the partners capital accounts in columnar format, the loan account, and the payables account. In the note, we are told to apply the rule in Ghana versus Murray. Of course, in the lecture video, I discussed this one. And of course, no worries, I will be able to still talk about it, even if you have not run the lecture video. For those who have just come in, I mentioned that I've already uploaded a lecture video on dissolution of partnerships, accounting for partnership dissolution. So we are saying in the slide, we mentioned in the slide that when a partnership is dissolved, the following steps are taken. When the partnership is dissolved, the following steps are taken. So the very first step is to transfer all assets. Okay, step number 1. All assets except cash and bank balances are transferred to the realization account. At their book values. So it means that when the partnership dissolves, we need to open up what we call the realization account. So that's what I'm going to do. But of course, in the discussion, I still gave the accounting entries. We shall debit the realization account with the book values of these assets and credit the individual assets account. So I'm going to make use of an Excel sheet. So this is my realization account. So what we are told in the discussion is that what we do, the very first step, is to debit this account with the assets. We transfer all the assets to the realization account. Now, as per the accounting entry, we debit. When you look at our question, the assets that are given to us, we have land and building, which is 79 million. So I'm going to take the 79. Plant and machinery, 65 million. So I'm going to take the 65. Motor vehicles, 16. So I'm going to take the 16. Then I have the receivables, 25 million. So I'll take the 25. Inventories, 41 million. So I'll take that one. And then the provision for bad debts, this one I'll just deduct it from the 25. So I think that is all for the assets unless otherwise. So that's what I'm exactly going to do. I'm going to bring the land and building. Okay, that is the 79. I'll bring the plant and machinery, that is the 65. I'll bring the motor vehicle, that is the 16. I'll bring the inventories, that is the 41. I hope that's the figure for inventories. Yes, that's the 41. Okay. Then I'll proceed to bring in the trade receivables. As I've mentioned, the provision for doubtful debts has to be deducted. So that comes to 23. It's supposed to come to 23, I think. Yeah, it's supposed to come to 23. 25 minus 2, that's 23. Then I have the dissolution expenses. This one we shall see it later. But basically what I've done is to bring all the what? Is to bring all the assets to the realization account. And that is our step number. That is our step number 1. All assets except cash and bank are transferred to the realization account. So after that is done, we move to step number 2. Now in step number 2, we are saying that each partner's current account is cleared to his or her capital account, since the distinction between the two is irrelevant at this stage. So what we are saying is that this distinction, this separation of capital accounts from the current accounts, of course this is for a going concern. If a partnership is a going concern, then we need to separate capital accounts from the current accounts. So we are saying that if a dissolution takes place, we shall combine these what? We shall combine these two. So that is our step number. That is our step number 2 here. Each partner's current account is cleared to his or her capital account, since the distinction between the two is irrelevant at this stage. So as you can see, we debit the current account and also we credit the capital account. We debit the current account and credit the capital account. So that is what I'm going to do in our Excel sheet here. This is what is representing my capital accounts. So the capital accounts I need are for the 3 partners. As you can see, we have Wanda, Kalule, Mwambu. So I need both on the debit, okay, both on the debit and credit side, those fellows there. So I have Wanda, Kalule, Mwambu. Then I also have on the credit side, I have the same people there. Now, what we know is that the capital accounts will have credit opening balances. So I do believe that the balance brought forward for the capital accounts, okay, the capital accounts should be a credit. However, you will also agree with me that at times the opening balance may be a what? May be a debit. So it doesn't stop us from having debit opening balances for the capital account. It doesn't stop us. So as you can see in our question, you will observe that some of the partners have debit balances while others have credit balances. However, for the capital accounts, it is rare for them to be in credit, for them to be in debit. It is rare for these accounts to be in debit. In most cases, and in all cases, they will be in what? They will be in credit. So if you look at my capital account here, what I've done for the capital accounts, all of them, I've picked them up as they are. That is 98 for Wanda, then we have 20 for Kalule, and then we have 62 for Mwambu. Now, when it comes to the current accounts, you'll see that some people have debit balances for the current accounts. Kalule, as you can see, his current account balance is a debit, it's a negative. Whereas for Wanda and Mwambu, they are credit. So that fact is supposed to be brought into our account here. So for Wanda, it is 15. That's a credit. Kalule doesn't have any on the credit, so that's a 0. Then Mwambu has 11,000. Now when it comes to Kalule, his balance is a debit, so I have to bring it here. I have to bring it here as a debit. What? A debit balance. His current account is in red. So all in all, I have fulfilled the requirement of step number 2, where I'm required that each partner's current account is cleared to his or her capital account, since the distinction between the two is no longer relevant at this stage. Step number 3 is that all the assets are sold and liabilities are settled. The double entry is made between the realization account and the cash account. Any realization expense is debited to the realization account, and if partners take over assets, this fact is recorded in their account. So what we are saying here, that at this stage we now look for buyers of assets, because our partnership has closed business. So we look for buyers of the assets. At the same time, we must settle the liabilities. We must settle the liabilities. We don't have to just run away. We must pay off people what they are demanding from the partnership. Then again, we are saying that the dissolution expenses, all the expenses incurred on dissolution of our partnership, because you may need to hire like a lawyer, you may need to hire an accountant or an auditor to come and audit the books of accounts. So those expenses, we are saying, are supposed to be debited. Okay, they're supposed to be debited. So along the way, I give some of the accounting entries. For example, when assets are sold, money comes to the bank, so we debit the bank account, credit the realization account with the sale proceeds. Then if a partner takes over an asset, we debit the partner's current account, credit the realization account with the agreed takeover value. When a liability is paid, debit the liability, credit cash. Of course, you clear a liability using cash. And if a partner takes over a liability, we debit the liability, credit their capital account with the agreed takeover value. So all those entries have been given to you. If the figures differ, these are the accounting entries. Okay. And then finally, we are talking about the dissolution expenses. If these ones are paid, we debit the realization account and credit bank cash account with the amount paid. So when you look at my Excel sheet, most of these entries have been captured. For instance, the dissolution expenses, which are given, if you look at our question here, the dissolution expenses, I think, are given in note number 3. The dissolution expenses of 3.5 million. Okay, I capture those ones and they appear here. That is the 3.5 million. The other zeros are up there. Then, as we have said, we sell off the assets. Okay, in note number 1, we are given the sale proceeds. The sale proceeds, land and building, 90,000. That's what they give us. Plant and machinery, 45,000. Inventories, 28,000. What else? Accounts receivables. In note number 4, they were factored. Someone gave us 23.5. Okay, someone gave us 23.5. Yeah, that is all. So those are the entries that appear here. The land, they gave us 90. Plant and machinery, they gave us 45. Inventories, they gave us 28. Those are all proceeds. The receivables were factored and we got 23,550. All right, so there is something else here in the note. I hope you are ticking off. They are saying that Wanda took over 10 million of accounts payables. Wanda took over 10 million. There was a 10% discount. So that one is also brought into our what? That one is also brought into here. The discount that we received and also the loan. The loan was taken over. The loan, we gave out a vehicle. When you look at the something here, in note number 2, Wanda took over one of the vehicles, 14 million, as part settlement of the loan. When we see in our current liabilities, you see that Wanda gave us some money, 15 million, but he decided to take the motor vehicle to settle as part. So he's demanding us a 1 million, which has to definitely come from the bank account. So the loan has been settled for 14 million. Okay, we debit the loan account, credit the realization account, because the motor vehicles have all been transferred here. So for this 14 to meet this figure for the vehicles, we bring it here. Okay. So you will see that I also have my loan account here. I also have my loan account, and the balance of the loan is 15 million, not so, which has been settled in part by this motor vehicle 14 million. So that completes the double entry. This 14 million is completed here. Then, of course, as I've mentioned, Wanda will still be demanding us an extra million because he gave us 15 million. So we must pay him his balance through the bank account. So ideally, the 1 million has to come from the bank account, and that settles Wanda's loan account. So he's no longer demanding from us. We have settled him. Then the trade payables, as we have, of course, seen, the balance is 23,500, which partly we are taken over by Wanda. I think this is Wanda capital account. Wanda took over part of the trade payables. So that entry, I expect it to come to this account. Okay, that entry I expect it to come here, the 10 under Wanda. If you have not seen that part, it is here in the question. You're saying that Wanda took over motor vehicle as part of the settlement. Then here, Wanda took over 10 million of the accounts payables in note number 4. So ideally, the 10 million should appear in the trade payables account as required in the question, because they wanted us to do the trade payables account, which we have done. The 10 million will appear there, and it will also appear in Wanda's capital account. Okay, so that's what I've done here. He has taken over, and indeed the trade payables reflect that fact. Now we are told that there was a discount. Which is 1,350. Okay, there was a discount, and definitely the bank clears the balance, which comes to 12,150. So at the end of the day, the two sides of our trade payables account will balance off like that. The discount is talked about here. The discount is talked about right here. 10% discount. So you have to calculate that, but it will definitely give you that particular figure. That's what you're going to get. Then, of course, I think I'll end with the bank account. This one I'll end with it. So I was saying that our bank account, when you look at the bank account, you will see that we seem not to have had some money. We were in overdraft. You see this figure here, members? This one is an implication that our bank account is in liabilities. We overdrew the account. We don't have positive bank. When you look at this, there's no bank here. So when you're drafting your bank account, the opening balance is the 4,000, which is a negative. Now, as we have seen, we paid some of the dissolution expenses using the bank, which is this one here. Okay, the dissolution expenses. The dissolution expenses have been paid. Then you'll see that some money has come in. When we sold the land and building, it came to the bank. When we sold plant and machinery, it came to the bank. When we sold the inventories, the money came to the bank. When we realized the receivables, the money came to the bank. Then we have also mentioned that Wanda had to be paid an extra million because he gave us a loan of 15 million. He took over a vehicle worth 14 million. So at the end of the day, we needed to top him up with a million. So that million came from the bank account right here. It came from the bank account right there. Then Of course, the trade payables, we had to pay the entire balance on the trade payables through the bank. So that money came from the what? Came from the bank right there. So that completes the double entry. This and that. Okay, now let us see what is not yet complete. Let me take you to the next step. Okay, in our next step number 4, they are saying that when all assets are disposed of and all liabilities met, the balance on the realization account is transferred to the partners' accounts in their profit and loss sharing ratios. A debit balance on the realization account is a profit on dissolution, whereas a credit balance is a loss on dissolution. A credit balance on the realization account is a profit on dissolution, whereas a credit balance is a loss. Now, I want someone to tell me, how much do we have to close off this account, the realization account? The deficiency is where? Is the deficiency on the debit or it is on the credit? Debit side is bigger, meaning that the credit side will have the deficiency. Okay, you're right. So it is a deficiency on the credit side. So is this a profit or loss? From the notes we have said here that a debit balance on the realization account is a profit. A credit balance is a loss. Okay. So this is a loss. This is a loss. It is a loss on realization. Now this loss is supposed to be shared by the partners. It's supposed to be shared by the partners in their profit sharing ratios. And of course I've worked it out for you there. 4/8 for Wanda, 1/8 for Kalule, Mwambu 3/8. Okay. So if I get 4/8 times that figure, that gives, these are the figures that I get. These are the figures that I get. So I think at the end of the day, our realization account comes to that. So this is our realization account in full. Now we need to complete the capital account. So let me first bring the realization, the loss. Loss on realization, we credit the realization account and debit the capital account. So that's why my loss on realization comes in here. These are the figures. I'm just picking them straight. The 12,800 for Wanda, I bring it under Wanda here in the capital account. The 3,200 for Kalule, I bring it here. 9,600 for Mwambu, I bring it there. So those are the figures. Those are the figures. That's the loss on realization. And I complete a double entry like that. Now, I've completed the double entry, loss on realization. This is realization. Okay. So step number 5, these are the entries, okay? These are the very many entries. Now, step number 5, we are saying that at this stage where we are right now, at this stage, the total amount due to the partners should equal to the cash balance. The cash is distributed and the partnership is over. So the meaning of this is that where we are right now, we have sold off all the assets, we have paid all the liabilities. So what is remaining is let all the partners get their share of the bank balance on the bank, and then we all go home because the partnership has done what? Has come to an end. Now, let us move one by one. I want you to tell me, for the case of, let's begin with Kalule, because for Kalule there is an extra working. As we are told here in note number 5, Kalule could only manage to meet half of his deficiency before he became insolvent. So the meaning of this is that Kalule is in trouble. Why? Because his debit balances are bigger. You look at his debit balances, 24,532. This is a total of 27,700. Now, he has only 20,000 on his capital account. And the rule of dissolution is that if the partnership is closing and you are in deficit, in deficiency, you must pay. You must pay. So, it means Kalule has to give us the difference. Now, the difference is how much? We have 27,720. The difference is how much? Remember, the difference is 7,700. Good. Now, they have told us that Kalule could only manage to pay half of it. So, you get half of 7,700. How much is that? 3,850. Correct. So, Kalule could only manage to pay 3,850. So, that's the figure that you see is in the bank. So, he has to give us. Now, when you see our bank account, there's money coming from Kalule. Okay? There's money coming from Kalule of 3,850. Now, this 3,850 is only half, meaning that Kalule does not have more money to pay. So, who is going to pay the other half? Now, when you look at our question, we are told that we should use the case of Ghana versus Murray. Now, in the lecture video that I've uploaded onto your accounts, you will find that discussion of Ghana versus Murray, but I can still project it here briefly. Dealing with insolvent partners. Here we are saying that with the transfer of profits or loss from the realization account and the transfer of current account balances to the partner's capital accounts, a partner's capital account may have a debit balance, like for Kalule. A partner with a debit balance will be expected to bring in cash to meet that deficiency. But now Kalule does not have the money, he has only half. So what happens? We shall apply the rule in Ghana versus Murray, the case of an insolvent partner. So we are saying that in this case, a partner is insolvent and thus unable to meet his dues on dissolution. Court ruled in the case of Ghana versus Murray, 1904, case in England, that subject to the agreement you have drawn as a partnership deed, such deficiency was to be shared by the other solvent partners. So, Wanda and Mwambu, the solvent partners, must now meet the balance. Now, this is shared not in the profit sharing ratios, but in the ratio of their last agreed capitals. Now, when you talk about their last agreed capitals, by their last agreed capitals meant the credit balances on their capital accounts in the normal balance sheet drawn up at the end of their last accounting period. Okay, drawn up at the end of their last accounting period. Now, what does it mean? It means that we are going to ensure Mwambu and Mwambu and Wanda share that deficiency, the balance of 3,800. So I have a working here. Let me share with you the working just down here. Share of Kalule's deficiency. Now we begin with Wanda. Wanda has to share part of the deficiency. So the formula is that we get the capital balances. When you look at the balance sheet here, the capital balances, we have 98 for Wanda and then 62 for Mwambu. Remember, Kalule has already eaten his. It is gone. It's no longer there. So we are going to share. Okay. So we shall get the 98 for Wanda over the total times the deficiency that Kalule has not managed to pay. Times the deficiency that Kalule has not managed to pay. So my calculator, of course, gave me 2,350,125. Then when it comes to Mwambu, we do the same. Mwambu's capital is 62 over the total times the deficiency. Okay, times the deficiency right there. So that gave me that figure, 1.491875. So they are going to suffer that They are going to receive less that. So when you go back to the capital accounts, you see that I've transferred those figures. Karule's account, okay, those are the figures affecting Wanda and Mwambu. Affecting Wanda and Mwambu. So meaning that at the end of the day, these two people have contributed the same. It is like a contra. These two figures will appear here and also appear here. They appear on the credit under Karule because we are contributing for Karule the balance of 350. When you add these two, you get 350, so that the deficiency is 77 goes away. Then these fellows now suffer. And at the end of the day, our balances are now okay. You see that this is a 27 and this is also 27 for Karule. However, for Wanda and Mwambu, they are going to enjoy some money from the bank. They are going to enjoy some money from the bank. So you need the bank account here, because any money that remains on the bank account is theirs. It's going to be theirs. So it means that at the bank we expect wait. Okay, at the bank is supposed to be here. So these are the totals. So we are supposed to balance at that. So between me and you, I want you to tell me how much is Wanda going to get and how much is Mwambu going to get cash from the bank. Just so my computation shows that Wanda is going to get a figure of 107,841, and then Mwambu is going to get 61,908. So that is what Wanda and Mwambu are going to enjoy from the balance on our partnership bank account. So the same figures are going to be brought to the credit because we have debited the capital account. So on the credit of the bank account, we are going to have Wanda receiving the same figure of 107, and then Mwambu receiving a figure of 61,908. So at the end of the day, you'll observe and work through, you'll see that our bank account closes off with 190,400,000, and that is now the last step. We close off our partnership, close off the bank account, and everybody goes home happy. So congratulations, have managed to complete the accounting for a dissolution. If you have any questions and you need more clarity, you can just type in the comment section and post the comment. It will straight away come to my inbox. So for now, I wish you all the best and see you in the next discussion.